to all of you for turning out today, especially since the notice went out quite recently. We wanted to keep this gathering small and high level so that we could have a substantive discussion. And I want to say in starting that when we launched the book in New York in October last year, it was fun. I had great fun with Barney and with Ron Chadlin. And I'm really nervous about doing this briefing here because all of you know me. And there's a big difference, when you come back to your home market, it's like, don't we know this guy? We know how he thinks. And isn't that Emmanuel? What is he up to today? So actually doing this briefing here in our home market makes me more nervous than if I did it anywhere else in the world. So firstly, I want to say thank you to all of you for being here. I'd like to thank Barney Franks for being here. He's been a very dear friend for several years now. And it's very interesting that the conversations that we've had together, resonates at the back of my mind, even as the current developments are unfolding in the US. The interesting thing about this book is that I titled it The Great Transition because finance is undergoing a great transition. But in terms of a choice of a book title, if you typed in Great Transition into Google, you'll see that all the other books with the same title are about the afterlife. So you've got to type in the personalization of finance here to capture the full story. Okay, so remember this if you're writing a book in the future and to check who else has got the same title. I'm going to start by giving you a briefing of the book, and then we'll get into the substantive discussion with Barney and with Alex, two people whom I respect greatly. And the conversation can go any direction. And it's for this reason that we try to keep this briefing and this dialogue small. Let me start by quoting from a phrase that I learned as a teenager by a German writer, Wilhelm Rabe, who said, "The eternal is hushed and still, the temporal is strident and loud. Silently over the strife on earth moves the will of God." It's not because it's not in any way religious. William Rabe was more of a writer of things that are going on the ground, and it was for him to pick up ideas that will have an enduring influence on society. And he wrote substantively between 1850 and the early 1900s. And these were incredibly formative years in European history. Just as many things that are happening today at the geopolitical level, at the industry level, at technology levels, are incredibly noisy. And it's very difficult for us to identify the substantive issues that we need to put our fingers on that will help us understand what are the enduring trends that we need to be mindful of, instead of getting caught up in what's happening next and then next and then next. Now, with that in the back of our minds, if this was 2007, something that we would have been thinking about, and if we were having this conversation in 2007 and I asked you what's top most on your mind, you're probably thinking about the financial crisis, about Lehman Brothers, Bear Stearns, and the news unfurling as it was happening. I remember I was at Cybos when Lehman's went under, and we were all talking about it, the banking community, and what the implications were. GE and Basel III. I mean, if you're operationally, banks were thinking about the implementation of Basel III. But look at the number of things that were happening in the background that eventually came to define 2007. The iPhone was invented. Facebook went online. YouTube was invented, Netflix started, Google started Android, and all of these had far more substantial impact on our lives in the way we live today than any of the macro issues at the economic level. And Bitcoin was born in 2007, 2008, that period. So we look for the issues and the developments that are going to have an enduring theme in our lives. So today, if we ask what are we worried about in 2023, or what do we concern ourselves with, the reason we invited Barney Frank is because we are all very interested what happened to Signature Bank. We're all very interested what happened to Silicon Valley Bank and what's going on at Credit Suisse and so on. And we are all very interested in the trade war between China and the US about Ukraine. That's the big topic. But guess what's happening in the background? The cost of genome extraction has collapsed from about $1 billion 20 years ago to something that you can buy on 23andMe for less than $1,000, $900, $700. We now can edit genes to a level of precision that helps scientists deal with cancer and a whole range of diseases. Satellites, reusable rockets, we're thinking about living in space for longer periods of time. Yesterday, I saw a fund that was created to be able to extract minerals from asteroids, and they say that that's possible in 20 years' time. And those are the kind of issues that we're going to be affected in our lives and in the way in which we live in the future. Neural language processing, of course, has made ChatGPT and GPT-4 available to us. And the questions we are asking today is, what will work look like going into the future? Now, in writing this book, in putting it together, and even creating this dialogue, the people that I've had the opportunity to work with, who wrote the foreword to my book, are some of the most incredible people that I want to acknowledge as I start this presentation. Barney Frank, of course, the co-author of the Dodd-Frank Act. To be honest, for someone who's from Singapore, to have had the friendship of the man who co-authored the legislation that dictates the banking industry is a matter of deep pride and honor for me. But at the same time, my friendship with Barney is not all roses. We have some of the most interesting debates, and the phrase that Barney uses on me all the time is, compared to what, Emmanuel? Because I come up with ideas that he pushes back on, and he thinks, and he has to put in context in terms of how legislation is put together in the US and what he thinks the banking industry is like. The other person that I like to acknowledge is Richard Sandor, who wrote the second foreword to the book. And Richard had some interesting things to say in there. And Richard is the father of the interest rate derivatives marketplace and the father of the climate bond marketplace that we know today. And some of you here, as you start your own marketplaces, your digital exchanges, your trading platforms, I think about what Richard had achieved in his career, and he's hardcore Chicago open economy school, and the friendship that I have with him, and to get the validation from him that the things that I'm writing about in my book are things that he resonates with. And we had Ron Shavlin in the US. Today we have Alex Manson. The friendship that I have with Alex Manson is very interesting. I want to just mention that I want to take that a little further. But before I say that, someone that I came to know through Barney Frank was Scott Shea, the CEO of Signature Bank. And I was probably one of the two people who ever had him on video. You can see this on my YouTube channel, that I had a conversation with him, and he described to me Signature Bank 3 years ago, and how it was honest to goodness downtown New York bank that was very closely connected with the local community, and that it was taking an approach to cryptocurrency to invest in the future and see what it is that we are dealing with today that is incredibly dramatic. And so that friendship is also something that I can draw on. Coming back to Alex Manson, again, a friendship that is forged in the fierce battle of ideas. Every conversation I have with him at the coffee shops, I throw an idea at him and he responds, which I think comes from a traditional banker looking at innovation. The reason I respect him immensely is because despite being a traditional banker, he invented Standard Chartered Bank's venture capital platform, and he takes a position in a lot of the disruptive technologies that are potentially going to be disrupting his own bank. And therefore, he needed to be intellectually honest and rigorous in the way in which he assesses these technologies. And I find Alex an amazing friend at a personal level. I love the way he looks after his family. And if you look at his Facebook, he's out there cycling 150 miles around Singapore, and he does all the triathlons around the region and so on, and how he finds the time to do all that and to read my book in its entirety. And the interesting thing about after having read my book was, Emmanuel, surely you are basing your book on this book, which is The Sovereign Individual. Okay, and I was shocked when he introduced to me this book 6 weeks before my book went to print. And I said, no, I've not read this book at all. And what was both endearing and also helped me to put in perspective my own thinking, just before it went to print, was that the idea that the individual is being empowered in the information society is already out there. We are now entering a world where technology is empowering the individual with not just information, but the ability to own its own transactions. And that is transforming and disrupting not just finance or any one of the industries, but society itself. And so that's what this book is about. And I almost recommend that as a corollary to my book, because I come from the finance angle. I looked at money as a token, as an exchange of value, and how, as it's being disrupted, it's going to be disrupting all of society. And the conclusions that I came to in my book are somewhat congruous with the conclusions that are described in this book, but from a much more broader angle. Now, each of you have been given a copy of my book for the sole purpose that you're going to go into Goodreads or Amazon or into Google Books and write your own reviews. Okay, I want you to be honest, as I'm expecting our panelists to be honest in terms of discussing the things you agree or disagree from my book. And I do not write a book in order to be right. I write a book in order to put out an idea out there so that it can be torn apart, discussed, and brought to life in the way in which each of us have a takeaway from what you think you're reading in it. At the same time, it's my record of what I'm thinking today. I might change over time, but having that record helps me to track my own transitions in my thinking. Now, the book, of course, looks, formidable to anybody who's trying to navigate it. But the one way to map my thinking in the way that I've written my book is to map how I've developed the book. And by the way, this book was my first book. I now feel very confident that I now can write subsequent books. But I needed to get the first book out because it was a huge struggle inside my mind as to what is it about the future of finance that I can say that's not already been said, and what is it about the future of finance that needs to be said that requires someone who sits one step removed in order to write this book. So the first part of my book, I deal with some fundamental assumptions or fundamental dimensions. I put together the dimensions in which we need to think about the future of finance. The second part of my book, a lot of it has to do with bankers. And going back into the history, the geography, the economics of banking, and trying to recapture the substance of banking as it's being transformed into the digital age. And let me tell you this, banking is a beautiful industry. It's an industry that is sustainable only when it's predicated with its roots firmly embedded in society. And banking gets its energy from society, its sustainability from society, and its relevance from society. And that's what I've been able to capture because, you know, some of the stories that I had to go back into to try and recapture that, I think about, you know, Teng Hong Piao of Public Bank in Malaysia. I think about Hang Seng Bank in Hong Kong. I think about Grameen Bank in Bangladesh. I talked to community currency people in Kenya. You know, people who are doing grassroots work who kept faith with their local community, and that's where banking secures its substantive value, and that's what we're trying to protect and build on into the future. So a lot of the center of the book goes back to first principles to try and figure out what are the DNA elements of banking, and then project that into the future. And then as I was finishing the book, I said to myself, oh my goodness, if finance is becoming essentially individualized, it's going to have an incredible impact on society as a whole in the way in which entire societies are organized. And that's where my book resonates with what was said in the sovereign individual. And regardless of which countries that we come from, I spend a lot of time in China, which from the outside looks like is a very organized and a very dictated society. But even China is evolving over time. And even China is going to be disrupted by the technologies that are disrupting finance today. So now let's just go through some of the points that I put together from writing the book. Now, as I build my thought patterns in the book, I came up with some themes, and I want to be able to share with you some of those themes today. I talk about from platforms to personalization. I talk about the personalization of finance. I talk about the mass amateurization of finance. I talk about the financialization of everything. These are phrases that I put together, which over time they're going to find their way into Wikipedia and so on, because I want to build on these ideas. The financialization of everything, the liquidity that sits outside the institution, rather than the liquidity that we preoccupy ourselves with if we are running banks, with the liquidity that sits inside the institutions. And then I borrow an idea from another writer who talked about how society itself transitions from tribes to institutions to networks. And I end the book by trying to imagine what the next financial crisis is going to look like, because that sets the stage for bringing all of my ideas together. Not that I want to predict the next financial crisis, I just want to say what the elements of the next financial crisis will look like. Now, I start my book with the story of ICE. And the reason is, when you're writing a book, you want it to be as accessible to as many people as possible. And so the story of ICE helps the layperson to understand the transformation that finance is going through. And ICE, just imagine this, was once something that you sort out of the lakes of Michigan or out of Boston, the lakes in Boston, put it on horse-drawn carriages and carried it all the way to New York, which then finds its way into your glass of gin and tonic or whatever application you want to use it for. And that's what ice used to be. Today, what is it? What is ice? It's something that we generate in a refrigerator when we want it, how much of it we want, and how we want to use it. Now, what made that difference? It was refrigeration technology. And what is the essence of refrigeration technology? It started with a chemical called CFC, chlorofluorocarbon, which today is banned, but that's because we have other alternatives which are more environmentally friendly. But the idea in finance is to find the chlorofluorocarbon of finance. And what is finance today? It's exactly as what the ice trade used to be. The money in your pocket could have swirled around the world twice, undergone inflation, exchange rates, bank charges, security, and a whole range of other factors before it gets to you. So none of us are in control of the value and the use of the money that we use. And ICE had that origins. And we are now moving into a dimension where we will be incredibly in control of money. And we are moving in that direction. How long we get there is not very clear, but it's a journey. And having a sense of direction helps us to make a judgment call on all the technologies that will help us get there. Now, so in the first part of the book, the thing that I'm saying most importantly is not even directed to the people in the banking or finance industry. It's actually to technology in general. I'm saying to the technology people that the era of the platform age is eventually coming to an end. And the people who don't believe what I'm saying are the platform people themselves. I gave a copy of my book to executives in Google, and they just threw it back at me and said, no, that's not going to happen. That was before ChatGPT, by the way, right? And if you worked in Google, you would never imagine a time, no matter how short the Google's own history was, that there will come a time where Google would be disrupted, which it is right now. Now, what the people in the platform industry don't realize is how the platform industry itself had undergone several transitions. In the original iterations of Amazon, of Google, a lot of the platform industry was desktop bound. And the 2007 period that I talked about was when the platform industry went mobile. Now, what was interesting is in the 2007-2010 period, the success of Facebook almost disrupted it from making that transition into the mobile age. In fact, it was Alipay and WeChat that made that transition much more native than the original platform players, right? And it's funny that the Chinese were very bad starters when it was desktop bound. You had Renren, you had QQ, which if you look at it today, you'll think that it's just not usable because it's not user friendly and so on. But because they were not native to the mobile era, when the new mobile players came on board, they swam in it like fish in water and took it to a whole new level. Were non-religious about micro apps sitting in super app and so on, which the original players found it very difficult to make that transition. In fact, when you see what Elon Musk is trying to do with Twitter, he's trying to recreate Twitter by being native to the mobile era and the new era that's going to come through, which is Internet of Things and device independence, which is a whole new era that we are at the cusp of right now. And in the same way, like when you think about some of the issues surrounding TikTok, TikTok is native to the mobile era and it uses a lot of visuals, and therefore it's taken the the DNA of the platform era one step beyond what Facebook and LinkedIn and all of the other social media platforms were able to do. But the history of TikTok is also going to be short-lived. And that's why sometimes I think about the discussion on TikTok is unnecessary, because TikTok itself will become, a victim of the metaverse and multi-dimensional realities and so on. So this is what I'm saying to the platform people. Now, what's interesting is that I find is that a lot of people don't realize there's a fundamental difference between Web3 and Web 3.0. If you Google for the meaning of these two, they sound almost the same. But I know the individuals who promote the two different views. Web 3 was written as an idea by the co-founder of Ethereum. It was a blockchain-based idea. And Web 3.0 is an idea that is being promulgated by Berners-Lee, who is the person who wrote the code that set up the HTTP platform that we all use today. And there are two different realities that are in competition with each other. It is not clear yet which reality will become the defining structure in which human society will interact. Because if we go on with the HTTP view, then all of us will have to share our data on a shared platform. If we take the blockchain view, we all become platforms of our own. And that's a whole different reality that we're going to be faced with. Now, I'm saying a few things as I say that. Now, although the views that I am promoting, or the views that I'm sharing with you may appear a little high level, I'm constantly thinking about what they mean to us as business decision makers in this room or wherever it is that you are. One thing I'm saying is that the whole idea of financial inclusion as a theme is a lie. Okay, and I say that very vociferously in my blog, that every time I hear a platform player say, I'm doing this because I want to add financial inclusion, I say that, no, your financial inclusion is not as benevolent as you make it out to be. Why? Because the whole idea of financial inclusion is to onboard millions of users and then monetize them, because your investors require you to do that. And all the microfinance, the lending, the financial inclusion projects that I've looked at, the interest rates have not gone down. The interest rates when Grameen Bank started its physical model of lending to 6 women in a village was about 28 to 30%. It's still 28 to 30%. So the people who are promoting financial inclusion haven't brought their prices down at all. And if the idea is to get people who are not leveraged to come on to the formal economy and then to leverage them, then you're not creating wealth. You're actually spreading poverty. I'm saying that it's digital access that we want to promote, that the poorest person in the world has digital access, that he then can decide how he wants to interact with the rest of the world and helps him plug in to the global economy. I'm saying that platforms will become ubiquitous, but everyone who is going to be on a platform is not going to be profitable. And I have in the back of my mind digital banks when I say that. Now, in the middle of the book, as I talk to the banking community, I'm talking about the financialization of everything. What do I mean by that? Anything that can be turned into data can be financialized. And in 2014, I think it was, Jeff Immelt of GE said that the future income of GE is going to be in data, not in manufacturing. So by collecting data on all of its manufacturing processes and all of its supply chain processes, that's going to be the source of GE's balance sheet going forward. And I think that when you think of any new equipment, any new autonomous vehicle that collects data, it's the data that is going to be the asset that generates value. In fact, the US economy itself is being redefined from manufacturing and then to services and then to intangibles like entertainment, brands, and so on, and then into data. And I also see that as countries become increasingly indebted, as they issue more debt, it's the trading of that debt that generates income. So we're moving into a world where we're going to try to financialize everything. We're not going to be able to financialize everything. I give the story that mankind, eventually tamed only about 17 of animals that are more than 100 kilograms in weight and higher. It's not that tigers and lions cannot be tamed. It's just that it's not economically viable, necessary to tame them. And then there's zebras didn't get tamed, but horses did, and so on. So we're going to go through a phase where we're going to try to make into data a lot of the assets that we have today, but only some will become tradable and financialized. And that's the journey that the world is going through in the next many years. Now, am I going backwards? Okay. Now, in the third part of the book, but before, sorry, and the thing is about financial institutions as they get disintegrated, or rather their roles get redefined in going into the future, financial institutions will find that the data that sits outside the institution becomes more important than the data that sits in the institutions. And that's something that banks haven't figured out yet. I want to talk a little bit about the mass amateurization of finance. As technology evolved into APIs and greater democratization, where because of open source computing, anyone is a programmer, it's a phase in the evolution of technologies that banks missed. Because if you look at the way in which the banking industry treated the API industry, it wasn't the same approach as the technology vendors did, which was to allow 6-year-old kids to go onto a gaming app and build their own games. Banks treat API vendors as, I call them patch solution vendors, basically, to come in and solve small problems in the bank. When in actual fact, banks should be allowing everybody to have access to plug into the institution. Now, having missed the API revolution, the API revolution is now morphing into the crypto space, into the personalization space, and banks will have to do an incredible amount of rethinking to try and figure out how to plug into the data that sits outside the institution rather than the data that sits in the institution. Now, as I then go into the last part of the book, I've asked this question: so how should people in the finance industry think about the future and think about what they need to focus on and build on? And this is the part that was very difficult for me to suggest and put in my book and build the confidence that it's an idea that is worth pursuing. I am saying to banks, give up your most beloved products. And that's not easy to do. We all think that the deposit business is the most important product in the banking industry, and the lending business is the most important product in banking. And if you look at the balance sheet of most banks, it's the mortgage business that makes up easily 50 to 60% of their portfolio. Now, Ken Regoff, I think, wrote this book, This Time is Different, trying to suggest that in finance, things don't change. If you look at the history of Basel regime and how it's evolved, things have changed. The first Basel Accord in 1984, and actually the FDIC chairman, Bill Seidman, said this to me. He said that Basel I took 1 day to decide. They all got together, and within a day, they decided that it will be 8% capital against your total assets, and that's it. That's what all banks should have on their balance sheet. And what was the bank's balance sheet at that time? 60–70% of that was mortgages. And what kind of mortgages? Real mortgages of real houses that sat on the balance sheet. And over time, the world changed. I think that when you juxtapose how Basel was developed over time, and you look at the crises that defined that, there was Black Monday in 1987. That was a securities crisis. It was a markets crisis. And guess what? The banking industry figured that getting into the securities industry, holding securities assets was a good thing for the bank. It added to the profitability of the institution. And so when Basel II came about, they added credit risk, operational risk, and market risk as a dimension for risk management and capital adequacy and protecting the institution. By the time Basel III came about, and that was the result of the 2007-2008 crisis, the balance sheet started looking even more different because by that time, what banks had on their balance sheet were derivatives of derivatives. In other words, they don't even own the underlying assets anymore. Now, and trading risk and a new form of risk, which was counterparty risk. This is, to me, the banking industry's entry to the network community, which is that you can have systemic risk in a way that didn't exist before because of the way in which banks were trading, but not just trading. A lot of the trading was between themselves, with each other. Now, if that's the trend, we can already start trying to figure out what Basel IV might look like. With the Signature Bank and the Silicon Valley Bank crisis, what crisis was it? What's the name that we're going to give this crisis? The digital risk crisis? It's a digital risk in two forms. One is the asset itself, which, by the way, I think we're going to have this conversation afterwards with Barney, which is that the digital asset didn't show up on the balance sheet of any of these banks, including Silvergate. Although Silvergate was a very powerful player in creating the on-ramp, off-ramp transactions, right? And so what Basel regime is showing us is that the balance sheet of the financial institution is becoming increasingly esoteric. It is not built on fundamental assets anymore. Now, so then the question is, if you're asking me, how then should banks reimagine the products? How do we even start doing this? And actually a related question in there was the question of why is it that the fintechs that started wanting to disrupt the banks and close them down today are applying for banking licenses more and more? Now, the short answer to that in my book is that because they were selling the same products as the banks were. If you are a peer-to-peer player who is selling mortgages, it's just a matter of time before the regulator gets to you and slaps on you all the same rules as they have on banking. And then it comes clear to you that, that the best thing for you to do is to apply for a banking license. But let's look at the deposit business. It's a business that you never think will be disrupted. But what was deposits in the old days? And that's where the middle of my book is very important, because I'm calling back into memory what the deposit business used to be. The deposit business used to be the lowest cost of funding and the safest source of customer base in any community. If you go to any country, land at the airport, look at the balance sheet of the largest bank in the country, they have the best deposit base, the lowest cost of funding. Public Bank in Malaysia and Hang Seng Bank were world leaders, not just Asian leaders. And that's one of the nice things of being Asian, is that I can see the world in the US and in Europe from here, and then take a position that is much more broader than if you're looking at the world from there, looking out. And their cost of funding, their cost to income ratio was like 30%, and sometimes even less. And there was a banker in the US whom I know very well, Vernon Hill. who started this bank called Commerce Bank Corp, and he was the most efficient collector of deposits. Efficient collector of deposits also means that you know your depositors personally, and they are also therefore good credit customers because you can build your credit book safely and you can scale. During the time when Public Bank was scaling its loan book 30% year on year, the other banks in Malaysia were looking at them and thinking, how can you do this without getting into trouble? And that's because it had a very strong depositor base. And Vernon Hill in the US, by just allowing people to bring in their dogs to the bank branch, having coffee and having money changing machines, became the most efficient deposit-taking business in the US. And he didn't even build a lending business. In fact, he built a balance sheet that was reinvested in treasury bonds, just like Silicon Valley Bank did. And the funny thing was that in the US, that was the best thing you could do with a low cost deposit base, which is collect as efficiently as you can, put it into treasury bonds, and go home and sleep or go play golf. And that used to be the best thing you could do. And today, even that is being called into question. And then what happened? Digital wallets. The platforms started to become more efficient collectors of deposits than the banks. The digital wallet business, I think total bank deposits now globally is like $230 trillion. Digital wallets like $20 trillion at the moment. There was a time when deposits were growing at 60% per annum, and now it's in total decline, especially in the US. And digital wallets are growing 20%, 24, 25% compounded annual growth every year. So the platforms are becoming more efficient collectors of deposits. And so banks have already started to becoming disintermediated on the deposits front. And then the question is, what are the new platform players doing with the deposits? Banks don't give good interest on the deposits in the first place. I mean, to go to the ATM and withdraw your money, your taxi fare wipes out the interest that you were being paid. And what do the platforms provide in terms of the deposit accounts? Great connectivity for a whole range of digital applications that makes it important for the user to have the deposits on these platforms in order to run their everyday life. And so the reason for the deposit business has evolved. And where is the deposit business going? It's going to a point where deposits will no longer need to be a balance sheet, a digital expression of the balance sheet position of your account with the bank. That's what deposits are today. They can become tokens that you don't even need a bank to hold. And that's what the future is looking. Now, I've not said the word cryptocurrencies at all in my presentation because I'm not coming from that world. I'm coming from the traditional banking world and looking at the transitions as they're taking place. So what I'm saying to the banking industry is this. Remember Kodak? They invented digital film in 1995 along with a few others. Guess what? They loved their 35 mm physical print film right into the 2000s when Sony introduced the digital camera, the CyberShot, and 2007 when the iPhone enabled greater photography to be done on the iPhone, and 2010 when Kodak went bankrupt. So it is possible that even on the most honored of banking products, the banking industry is being disrupted. And maybe that's what the conversation we need to have with Barney and with Alex afterwards, which is that what happened at Signature Bank? Not only is there such a thing as too much deposits, in fact, it was Jamie Dimon who said that who introduced this term that I have in the back of my head, which is excess deposits. In other words, deposits to the bank really doesn't want to have. It's a business that gives the bank more trouble than it's worth. So we've already entered that realm. And now we're entering a realm where the deposit is something that the user needs to use, not in order to earn interest or generate wealth, but to help him connect in a whole range of utilities. Now, so what I'm saying in the future of deposits is also that it is very likely that the best issuers of stable coins in the future will be traditional banks. Imagine a world where every bank issued its own stable coin and competed with each other on the utility of those stable coins. What is the stable coin's biggest problem today? It is that it doesn't have the governance structure to warranty that the value of the stable coin is what it says it is. And which are the institutions that have the best credibility to build that governance structure? Banks. So I see that there will come a time when the best issuers of stable coins will be traditional banks. Okay? Remember I said this. It's not whether it actually happens, but that's the direction in which we are heading, and anything that happens will be a variation of that. So as I finish, I actually borrowed an idea from, you'll see this in the last chapter of my book, from a RAND Corporation analyst, and he's an elderly man right now living in the UK, David Ronfeld. And he said in 1994 that society goes through 4 transitions, from its tribal to its institutional to its markets and to its network phases. I found this model very transposable into the banking industry. When I looked at what happened in the LIBOR crisis, I thought it was a crisis of transition rather than a crisis of deception. It was a case of the markets players, the traders, looking over the institutional players, the rate setters, and looking for indices that they can use in the markets. And that's where the discrepancy took place. In fact, think about this, almost nobody got convicted for a duty of care to the other to this day. Okay, and the one conviction that happened is being reviewed in the UK courts right now. Right, so the thing is that as we transition from one phase to the next, there will be disruptions that we need to deal with. And I'm saying that there will be more cases of LIBOR type instances as we transition from our markets based industry today to networks. Now, when you think of something like cryptocurrencies and the way they're talked about, as long as you're talking about them in the market space, in other words, the trading phase, that means that willing buyer, willing seller, I have a price for it, you exchange that token, that asset with me, all the rules of the market space apply. So what Charlie Munger says about crypto is correct, as long as you're dealing with it as a markets instrument. But crypto will have a different function, a different value when it moves into the network phase. There, it's not the price of crypto, but the fact that each one of us, even today, can issue our own crypto, put it out there in the market, and see who else would want to transact with us. So these are the thoughts that I have in my book. They're all original thoughts, or thoughts that are hedged on original ideas that wants to speak to an industry in a way that it's never been spoken to before, takes a high-level view, but with an intention of creating a roadmap that we all can use to guide us in our journey. And now, I want to test these ideas with 2 people I absolutely respect, Alex Manson and Barney Frank, and reconnect these ideas with some of the things that are happening or taking place today. So I'm going to ask Alex to give his top of mind reaction to what I've just said. And I'm holding my breath because we don't rehearse this thing, right? So, and he's so opinionated, he presses me every time I meet him, right? And then for Barney to give his reactions. And then I would like all of you to ask questions and take this conversation in any direction that you want. Okay? So, Alex.
First things first. And now we know that you've been running the Asian Bank for 28 years. You started pretty early, you were 15 years old.
Yeah.
Thank you.
Top of mind reaction,
was reflecting on the travel, clearing immigration. You know, when they give you a menu card in plane, you have to, both countries aren't digitized yet, and so you actually have to write down your name, 1 letter per space, and at some point they ask you for your occupation. And the question is, what do you write? And I never thought of it. And certainly pre-08 banking crisis, banker, no problem. At some point, post-08, people stop saying banker. In fact, I got stopped at immigration a few times. Immigration officer, are you sure you want to come to this country? And what sort of banker are you, right? So the point is, what do I write today? And the answer is banker. So, which is an interesting fact, right? So we're talking about it, and making the question, why? What does it mean? And I go back to an intimate conviction, which is that banking and financial services is actually useful. It's actually useful. It serves a purpose in world and society specifically. The question is, who the fuck are you doing in the first place, but also how relevant, and Barney, how do you make this relevant for generations to come? So I think the immediate top of my reaction is that we're having a conversation about the future of banking, we're having a conversation about technology. We've invented another kind of bar, right? I can't think of any civilization that has uninvented bar. You have bar is a good thing, but also hurts. You burn your house, so you have to learn to deal with it. And so we're going to have to learn to deal with as far as we've invented. And so the questions are, what does that mean in the context of banking and financial services? What does it mean in the context of identity? You're not having this debate about whether controls identity, controls finance, is it all about transacting, or is it, it's transacting a corollary of it. But really going to the root of the societal questions that are being asked now, including nothing to some individual, the evolution of from nation states to other forms of institutions, perhaps, and reflecting on what the purpose actually is of being a banker, and what does it mean for us to fulfill society's expectations of financial services. Maybe I'll pause here. The top of my reaction to the questions you're asking is exactly that. It's all about relevance.
Thank you for that. But then the related question, in order to put it in context, is you make decisions on investing in disruptive technologies. What guides you?
So, for a start, when we talk about rewiring the DNA in banking, part of me is saying, well, it's actually not about the technology, stupid, paraphrasing someone else's quote. It's about the DNA. Technology, don't get me wrong. So the president and the neighbor is very, very important, and you can be important to understand what it does to you and for you. But it's less about investing in technology than it is about investing in a new form of DNA, which is how you do business, how you serve customers, how you do things that are wrong. So predominantly, I think we're looking for problems worth solving. We're looking for use cases. We're looking for the way customers want and in fact need to be served. And we do our very best to try and serve them this way. So what we're building, what we invest in technologies, we're also building businesses. And those businesses which we build as those operators of businesses are different business models, meaning the different ways of serving customers and at large addressing society. That's the starting point. On the back of which, well, for business model XYZ, you need technology and there's a number of foundational technologies beginning with data science and infrastructure, including unlimited to blockchain, which takes us to identity management in the metaverse, which we can have a conversation about. The number of foundational technology that we need to be extremely aware of, because they feed into the business models, and in fact, they enable the business models to address real problems. And I have data about self-serving or not, but put financial inclusion aside, whether people are disingenuous about it. The point is we are talking about serving customers the way they need to be served. All this inclusion if you want, but that's kind of the point. Serving them the way they want to be served, which is based on data science, which is based on famous information synthesis on your slide just now, which is based on algorithms, which were debated earlier, which enable us to do things that previously, not just banks, but humans weren't able to do. And moving to the next generation of services, specifically financial services, to enable what people want to do.
Before we go to Barney, one more question, which is, in your position as chief executive of, I know you didn't dislike that phrase, but of SG Ventures, do you find yourself intellectually honest enough to invest in technologies that can disrupt the very institution that you are working for?
Does anybody ever answer that question? No, I'm not even clear.
Let's see what his answer is.
No, I'm completely dishonest. It's really all about being self-serving and.
No. What I was, let me finish my question, which is that you find yourself thinking about preserving the existing institution. That was where I was getting.
And this is the challenge. By the way, there's a movie footage that everybody discovers, which is in order for things to stay the same, things have to change, which is mafia boss speaking. And so what I don't mean to make an analogy to the mafia. There's an element of the element of asking a more specific question in the context of a corporate, which is how many corporates can you think of that have genuinely transformed themselves, changed themselves from within, and got credit for it from their customers and by extension the market? The answer is very, very few. The jury's out of the few that I can think of that can count them with my fingers. So the premise is we need to evolve, we need to change, but this is not going to happen unless we are willing to cannibalize, as they say, unless we're willing to compete against ourselves, unless we're willing to do things fundamentally differently, which is potentially detrimental to the existing business. Now, it's a difficult thing to do because as a bank, I have a fiduciary, any organization, I have a fiduciary duty to shareholders and stakeholders, including regulators and policymakers, but also society at large. And so sorry. I'll do this. I'll do this, and hopefully, everybody can hear me. So we have a fiduciary duty to a whole bunch of stakeholders, and so destroying the organization for the sake of building a better one is just not an option. Hence, the conviction required to that we're going to change from within. We are going to digitize the bank. We're going to improve it. And by the way, this is hygiene. This is non-negotiable. If you don't do this, the consequences are existential. And so, of course, we'll do this. But we're also going to build things that are fundamentally different and could, over time, replace the existing bank or complement it or form adjacencies that we can't even think of. And so the honesty comes from that willingness to overlap, at times compete a little bit, do things differently, do some of the same things very differently, completely different things, and rebuild or build financial services the way we're envisioning them in the future, driven by customer needs and what society is expecting, but separate and distinct from the existing organization. Okay, the conviction we acquired is that in order to rewire the DNA of banking, we have to do both at the same time. We have to improve the existing so we can survive, from balance sheet management to everything else it needs to survive. And in the same time, we have to be willing to be against it, rebuild it, destroy it, things. But
I wanted to put that as an introduction so that we can, there's lots to discuss. Barney.
Couple things. First, I need to correct a mistake Emmanuel made.
This is our conversation.
The worst thing a comedian encounters is someone who botches things by giving the punchline without what we call the setup. So he gave you a punchline without the setup. Yes, there was a great American comedian in the 50s. He worked in what we call the Borscht Belt, the Jewish-oriented resorts in the Catskill Mountains north of New York. And he told jokes about wives and mother-in-law. He was called the king of the one-liners. And he told the shortest joke in history. Take my wife, please. That was his whole genre. But the one I found the most important and a guide to every decision I had to make. How's your wife compared to what? That's the setting for compared to what. There's a more elegant version of that in French from Pierre Montespan, I think the best prime minister of the Fourth Republic. Gouverner, c'est choisir. And that's what I tell Emmanuel. So what do we do about it? Compared to what? Second thing I would say is, and I have one fundamental difference. I believe he overstates the interest and ability of the average citizen to create his own currency or to make his own decisions. Yes, it is important for people to have that option. But, I spent 40 years appealing to the electorate. And I obviously ultimately had to do what they wanted. But I did not gain in that process an extremely high judgment of their capacity or willingness to make tough decisions. I mean, I said at one point in frustration, when I was still in office, look, I understand we politicians make a lot of mistakes, and the media drives me crazy, but the voters are no bargain either. And you are assuming, let's go back to communication. The ability of individuals to access information directly without any intermediary is a disaster. The internet is the greatest purveyor of misinformation in the history of the universe. Now, we can't stop it, but let's not celebrate it and let's think about ways that you might deal with it. And similarly, I don't know what it means for everybody to be able to issue his or her own currency. I do know one area where people might have thought about that, which was non-fungible tokens. That's self-contradictory. You said you're looking for an exchange. How do you exchange non-fungible things? And maybe I don't understand those two words. I thought they were kind of the same thing. So I think what the job is, first of all, to accommodate the new technologies, to give people and let people take advantage of that, to let people who have the ability and interest in taking on more of their own activity, get the savings from that, the efficiency, but understand that large numbers of people are always going to want institutional intermediation. And not only that, if we did not have that, it would go bad. Side point on that about inclusivity. I agree with you. There's two kinds of inclusivity. What we have talked about at the federal level, by the way, is not increasing the poor's ability to borrow. We are increasing their ability to get money without paying enormous fees. I want to abolish check cashing, which costs them a lot of money. We want to abolish the extreme fees on currency sent back home. What we're talking about is giving them free checking accounts so they can get a paycheck and when they get the money. That's what we mean by inclusivity. I agree with you. Once you go beyond that, we're not trying to monetize them. We're trying to allow them to monetize what they're already earning. And I'm glad you said that, because I think I will be more clear in the future to say we are talking about giving them access to that money for free, not putting them in trouble. And then that would lead to a next point. If we get the banks out of their current business, who is going to do the lending that I assume will be society needs? Who who helps people buy their houses? I mean, somebody's got to have that lending function. And if deposits are not the basis for the money that's lent, what will be? That's why I said, you know, what do we do next? Next point is that when you say the banks will compete with each other with their stable coins, how do they compete? Well, how do you make money? I issue a stable coin at the bank. How do I make money off that? How does that sustain me? People have to pay me, or they pay me a fee to use it, and I guess then we charge them lower fees.
Yeah, so now, the comments that my two distinguished panelists are throwing in are very important to bring the 30,000 pips, ideas to what's achievable today,
Let
right?
me throw one last one, and that is this. And it's Schumpeter, creative destruction. Because part of what you're saying as a banker and to bankers is, look, what you're now doing isn't gonna work. Let's invent something else for you to do. So the Schumpeterian answer is, what you're now doing isn't gonna work. 10 years from now, go off into the sunset. There is no societal need or macroeconomic need to invent a new function for banks if their old function is obsolete. So, and that's why I think you may get a little sketchy, because you have this incentive to find something to do. I mean, again, that's, I think, classic Schumpeter, what they've been doing, and we've had other, hey, let's go back to an analogy that somebody suggested. There aren't ice choppers anymore. We didn't find a new role for the people who chop the ice. We let them go off and do something else. So that's my last point, is I think you can get it's an overreach to try and find new things for the banks to do. If what they're now doing isn't useful anymore, no more banks.
Okay.
But I think come up with a way to reconcile what you're saying, which is on the one hand, you're saying, well, individuals have the ability to create their own profit. True. Individuals have the ability to create their own story, their entire narrative of themselves and everything else on the internet. True. You think that may not be good.
No, not two things. It may not be within the second line is this. We are people who are in banking, we're intellectual. A lot of people don't want to be bothered doing that. They want to go and do their job. They want to paint, they want to be a carpenter, they want to be a farmer, and they don't want to have to deal with it. They want to pay somebody else to do it for them. And I think you overestimate the extent to which people really want to do that, rather than say, oh yeah, that's your problem.
Right, great. I'm a banker, can I help?
Yeah.
And this is the point, which is, at that point, there's not really help, right? So what is missing in the context of digital assets in the world today? Robust, safe, compliant infrastructure. You can ask with what, because it's a real question at the moment, but robust, safe, and trusted. What is somebody going to expect in the context of truth on the internet? What is my trusted source of truth? If you trust me with your money because I'm a bank and you used to put it in vault and now it's a digital vault, perhaps you might trust me with information and records, financial record, how about health records, how about any sort of data, how about identity management, which is ultimately what you won't be in physical or virtual reality. It's a number of things. So I started with infrastructure and trust around infrastructure, moving on transactions, but I can think of a bunch of things for banks to do in the context of.
And by the way, one that's going on now, Goldman Sachs has greatly increased its wealth management business and got out of and diminished its trading business. So, is there a role for wealth management in your future?
All comments valid, okay? Just for clarification on the stable coin, the value of stable coins is the utility. In other words, you add functions to it, and banks compete on
So you
that.
can do more with it.
Yeah.
You'll pay more for it because it has more use for you.
Yeah. And even now, the beauty of stable coins and of crypto is not the value. It's not crypto being $30,000 today. It's the fact that there are easily 300,000 programmers working on applications on, Uniswap, for example, right? Or any one of these cryptos. So it just attracts anybody out
So
there.
your job is to make it more attractive, not to the person who buys it, but to the people they're gonna deal with. You have to make it more attractive to the.
Whatever the utility of it, right? And people will continue being farmers and carpenters and whatever they want to do. But when the time comes for them to transact value, they will be scrambling for how can I create a token that can be bought or sold.
They're too busy farming to then don't become a comparative shopper among stable coins. I mean, that's, by the way, let me just say, that's my problem with people who don't like deposit insurance because it promotes moral hazard and they want the borrower, the depositor, to be shopping around. Well, analysts can't figure it out. The FDIC didn't figure it out. The Fed didn't figure it out. So how is the average small business man supposed to have known that Silicon Valley was in trouble when none of the analysts and none of the regulators did? Plus, a lot of the information you would want to decide how sound a bank is secret, you can't get it.
So valid comment, because Adam Smith said that it's a small business that's the most efficient form of organization. But what happened from the 300 years since Adam Smith was that it was large businesses that dominated.
Mhm.
And I say this in my book, that Adam Smith said that the individual is the most efficient purveyor of labor cost or production cost, all that. But in fact, later it was, I think he was a Nobel Prize winner, but Ronald Coase, right? He said the reason big businesses eventually took over was because there was a dissymmetry of information between big business and the individual. The individual had no idea what the cost of labor should be or how competitive his cost of production was. It was the big business that could, consolidate this cost and be more efficient. Today, you see greater symmetry of information. In other words, the end user has the same information as the producer. And so the dynamics are changing. The fact that the dynamics change or don't change, they're a function of how information is shared and so on. And that's why that book, The Sovereign Individual, is amazing because it just imagines what happens to society when all of us have the same information as the producer and each other in that way.
So here's the problem with that. The information can be available, but accessing it can be difficult.
Yeah.
So if I am a Fortune 500 corporation and I got to figure out what bank it's safe to put my money in, although increasingly they may not do that, but I can have a whole department of bank analysts who can decide and look at the bank. But if I'm a guy running a small manufacturing business, I don't care if that information is available. I haven't got the time or the expertise to learn it.
I love what you're saying because you're bringing it back to what exactly is happening right now, which is that the Silicon Valley Bank
And it's inevitable. There's no way to fix it.
depositors, they have no time to figure out whether Silicon Valley is.
And by the way, some of that stuff is secret. You can't, the regulators cannot get some of the information that you need.
But now with so much information available, people can put up the entire balance sheet of the bank and show there's a $60 billion hole in there.
And to your point earlier, information is available at some point instantaneously, indicatable deposits instantaneously, which is the run of the bank that we were
Which is what happened.
discussing, which is exactly what happened. So the ability of an individual to react to information is immediate, it's irrevocable, it's there. So the element of how do you deal with it? What
But
is
you
the
don't have the
framework?
time and the expertise or the capital to hire people to look at it.
Okay, one more question to Barney before we open this up. How has your mind evolved since Signature? Like what happened since Signature?
Oh, it went back to a point I had when we did the financial reform bill. I refer to it as the financial reform bill because I don't call it Dodd-Frank, because in my lifetime, only one person that I can think of was able to refer to himself in the third person and not look like a pompous twit. That was Charles de Gaulle. Anybody who calls himself by his own name, who is not Charles de Gaulle, looks ridiculous. So the financial reform bill, one of the things we did, and this goes back to me, is we talked about this before, and it's a point that I agree with both of these guys that It's the information technology. We had a financial crisis 15 years ago, in part because information technology enabled institutions to get into what we would technically call financial razzle-dazzle, and it got away from us. That's now migrated. That information technology has now empowered the individual depositor. So if you want to get your money out of the bank, a bank run was called a bank run because it was a physical journey to get your money. We're moving your deposits from a bank now consists of, and it's moved, 2 buttons. And so we have back in the, 3 times in American recent history, the federal regulators have expanded the deposit insurance guarantee amount to deal with the crisis. 2008, the pandemic, and now. I tend to think if you have had to do something 3 times to deal with the effects of a crisis, maybe it's time to think about doing it before the crisis. So but I think that's the key. And by the way, you asked about Signature Bank. What happened to Signature Bank? 2 weeks before we were closed by the New York State regulator. No federal regulator was involved, except the FDIC had the duty to carry it out, mandated to them by the New York State regulator. We were not a federally chartered bank. We were state chartered and subject to the state regulator. And 2 weeks before, we met with them and the federal regulators at a regular meeting. All the board was there. They reaffirmed our #2 camel rating. They made no alarms about things. On the Friday before we were closed on Sunday, $12 billion in deposits migrated out of our bank in 2 hours on Friday afternoon. And I believe it was because we were known as one of the most heavily crypto involved, as Emmanuel pointed out. We were not at risk if crypto lost in value. We were a payment platform, other people were, but that scared people. And we were trying then to reestablish ourselves, and but the New York regulators shut us down. Had they not shut us down on Sunday, and we opened on Monday with the new liquidity facility that the Fed had opened and the guarantee of above 250 deposits, we would have been fine. But so in our case, Silicon Valley had some problems. In our case, it was simply, I think, a crypto hysteria generated, technologically turbocharged deposit run.
Was that regulatory overreach?
Yes, I believe that the New York State regulator, I think, some of the state regulators, I think, are at a lower level of competence than some of the federal people, and even more. I mean, one of the reasons I had always tended to be supportive of the Fed is very important point. The Federal Reserve is not constrained by the federal government's payment system, of its wage system. The quality of people at the Federal Reserve is higher than any other agency because they can pay twice as much and have fewer constraints because they're outside of that civil service. But I think what happened was this. I think the regulator was worried about crypto and decided to send a message that they want to discourage the banks that were under their jurisdiction to get too involved in crypto. There was a, doing a lot of French today. There's a French phrase, couler les autres. The story is that in the 18th century, the British, with their strict discipline in the Navy, shot a guy because there was a little unrest in the crew. And some Frenchmen said, oh, those British, they're very strange. They shoot one man to encourage the others. I think we were the crypto person that they shot pour corriger les autres banques.
There was a humorist. So Charles de Gaulle was notoriously a very tall guy.
Yes.
And there's a humorist called Jacques Fezon who depicted the wall of Colombe, which is the birthplace of de Gaulle, covered in insults, right? About the Fifth Republic, Algeria, all the things that the people hated de Gaulle for and took peace. But in this saying, which is, long live de Gaulle, on top of the wall, and the policeman said, very, very tall person. So this reminds me of the sort of thick skin that it takes to be a crypto fan. what it's worth. We're not saying Bitcoin's going up or down. I'm not even saying Bitcoin's here to stay. I have a view on it, but that sort of doesn't matter. All we're saying is back to the far, you cannot uninvent digital assets. Right here to say you cannot uninvent digital assets. You cannot uninvent the internet. You cannot uninvent
Exactly.
1.0. You cannot uninvent the metaverse. It's here.
Yeah,
For better or worse. So we've got to deal with it. We've got to deal with it from a framework perspective, from an infrastructure perspective, from a regulatory and policy making perspective, and indeed from a banking and financial services.
Before I got into finance and did more foreign policy, I would make the same point about nuclear weapons. It would be nice if there weren't any, but how the hell are you gonna
But
get
they're
them?
here. But they're here. So we need to deal with it.
Questions? Sorry, yeah, go ahead. Matthew, question.
Could someone bring me a glass of water?
Yes, if I can just say, I think, thank you very much. Very, very interesting insights from all three panelists. I think that's what you said, the fundamental purpose of banks and finance industries to be useful. We should remember that. Some guy in New York in a hedge fund trading bond convexity isn't useful, but helping women in Africa get a loan is useful. And as long as we have that filter that banks should be useful, that's a very good filter. And then what Mr. Barney Frank was saying is ordinary people, they're always going to want institutional intermediation for financial services because they do other things and that's good. And then you need government regulation. Some people are ideologically opposed to, but you need it. Like FDIC, like what Congressman Barney Frank did with the Frank Act. It's essential, especially in banking, because everybody is always vulnerable to a bank run. But I think, having tried to read your book, Emmanuel, I don't understand whole chunks of it, but I think the great insight of your book is that, given these other comments, that for the first time in our lifetimes, technology, data, all these new platforms and so on, are going to transform the way that banking works. And I mean, I started banking in 1987 in Hong Kong doing trade finance. It would have been recognized by somebody who walked in from 100 years before. It was basically the same thing. Yeah. But today, for the first time, I feel, Emmanuel, you set it up perfectly in this book, The Great Transition. Everything is going to change. We just don't know how. So I think that, to me, that's the great insight.
Okay, and then, as you moderate,
I just want to know if you agree.
when I talk about these things which the average citizen say, I'm talking about people who are busy in their lives, doctors who haven't got their practice is too big, or small manufacturers juggling all this who can't delegate it. Many of them, it's difficult today because it's new. It may well be that the trends that you described, which I agree are happening, 30 years from now, that may be easier to do. There were things that people would have been terrified of having to do 30 years ago that they now can do more easily. So that may come. There was one other, I want to add one other thing. When you said you looked at the great transition and you got into the afterlife, people should be aware, if you do that in America today and in England and some other places, it will be about changing your gender. The great transition today, literally, I guarantee you, if you do a content check for transition,
Yeah.
it's going from male to female. Or,
Yes.
vice versa.
Just speaking on one of your points, thanks for acknowledging the comment. For one thing I would say is it would be arrogant on my part to say that helping people in Africa is useful and trading complexity is not. In fact, I can also make a case for why trading complexity is useful in a number of cases. And so what Adam Smith also said is that the most efficient way of allocating resources is a market, and so let the market ultimately allocate resources, meaning decide what is ultimately useful or not, which is part of what we are approaching, changing banking we will do, which is building ventures and then sort of validate themselves commercially, financially, because ultimately the market will arbitrate whether what they're doing is a problem worth solving and putting people are willing to pay them for it or not. Great question now in the context of transition. The other transition is so if we're evolving from markets to connected world, the market to be individuals in a sovereign capacity rather than nation states going to develop, but individuals deciding what is useful and how will they decide about it, with what sort of information and what are the consequences of the decisions that which is, you're right, for Crystal, we don't know how, but this is what we're envisioning in the book and in this conversation.
Yes, question. So, go on, Shankar first.
Thank you. I just wanted to make sure I didn't miss the opportunity to talk to Mr. Frank about the 848 pages that you wrote for the Dodd-Frank agreement. And in the current scenario, do you see, by the way, I did get a chance to read all 848 pages. I'm not sure I understood all of it, but I did have a chance to read that many years ago. In the current environment, do you see more regulations? Do you see less regulations? And I'm also interested both Edie, your and Alex, your view around how you see regulation changing in the current environment.
If anyone is interested in reading the financial reform bill, Chris Dodd, when he was head of the Motion Picture Association, negotiated a lot in China over being paid for movie rights. And he brought home and gave me a present of Dodd-Frank as in Mandarin. So we have it in Mandarin if anybody wants it. As for regulation, and we've talked about this before about I think that needs, I do not think you're going to see much, you're not going to see any legislative change in the basic bill. I think you will see under the Biden administration tightening up of their administration of the current procedures. In 2018, we talked about there were amendments adopted in 2018 to the bill. They did not remove any of the prohibitions on improved lending. They didn't deregulate derivative trading or allow mortgages to be granted they should be. What they did do was exempt some banks from being under the mandatory requirements of tests, but the regulators retained every power they had to do that. And by the way, we were shut down by the state regulator of New York, who wasn't covered either by our bill or the amendments. So I think going forward, you won't see any change statutorily. I think you will see more information being gotten, stress tests and monitoring from the banks in the 100 to 250. By the way, even President Biden's reform, 50 is what I've said to people, if 50 billion in assets was the right number in 2009, how could it possibly be the right number today? I mean, 15 years later. So even Biden went to 100 billion. But I don't think you'll see much change there. What I would hope there would be, and I think very important, is to adopt regulation for crypto. Let me just give you a 2-minute, my theory of regulation. Got an economy, it's under a set of rules. Innovation comes, it has outstripped the rules. Problems exist until you get to the rules. 1870, no national companies in America. By 1900, there are. So you get in the first part of the 20th century, the Federal Trade Commission, the Federal Reserve, the Interstate Commerce Commission, etc. That works well, but stocks have now become so big and there are no rules for the stock market. So you get problems in the Depression. Roosevelt puts in rules for regulating the stock market, the SEC, etc. That works well until you get to the 70s and the flow of capital coming in and information technology, and you get into the financialization, the derivatives on derivatives, etc. And that leads to the problems we had to deal with in 2009. And we were talking before, and the question, well, were you dealing with the past? No, we were dealing with the present day. But in each case, I think what was done in 1910 and 1935 and what we did in 2010, they worked to prevent the problems that had existed because there was no regulation. But you now know there are going to be innovations. And I think there are 2 innovations that have to be addressed. One is because it's been technologically turbocharged, the ability to move your deposit is new. the fact that you can in two button pushes do that. I mean, years ago, the weekend, the problems happened on the weekend. Well, 25 years ago, that wouldn't happen because the bank would have been closed for the weekend. Second one is crypto. And I think it was an exaggerated fear of the volatility of crypto that generated the deposit level. And I think if there were, if you could get the kind of regulations of crypto, stable coins, stable coins could be a force for stability if there was some kind of definition of it that was accepted. So I hope going forward, you're going to see regulation of crypto. I would also like to see a transaction account increase in deposit insurance. As far as America is concerned, the Republicans are against that deposit insurance increase. By the way, go back to what you had asked us about self-interest, and Jamie Dimon just said in his annual report, yes, this shift of deposits from the smaller banks to us is good for us, but it's bad for the country. And I want to stop with the classic case of taking the long-term view of your interest. There's an ideological split over increasing deposit insurance, so nothing is going to happen. But I think there is a chance of regulation of crypto. One thing, the Democratic and Republican leaders of the committee that I used to chair, Financial Services, are very friendly. Even though she's got a reputation as the guy might be seen as a big conservative, I think it is possible that going forward there will be some effort to increase the confidence in crypto, which is what we need. And go back to have competition in the crypto issuance by the banks. The key is, among other things, that you will have confidence, that people will have confidence in your form. And so I am hopeful that you may see some increased regulation of crypto, which does not change the laws on deposit shifting, but diminishes the incentive.
So you're going to deposit shifting and payments, we're reflecting a lot on, instant payments, it's instantaneous, it's irrevocable, it's transparent, all of which is great, but also it suppresses the ability to correct a mistake, right? The number of times where we have been on phone calls on a weekend trying to recover some money that was, I called Swift, and we were able to repair a lot of damage this way. So there's a bit of a.
The question is actually, Scott Shea, who had been the chairman of the board, one of the founders, is a very observant Jew. And he had to work on Saturday, seriously. He had to work the phones on Sabbath. That's how I knew how serious the crisis was, literally.
Yeah. Maybe another point. So when you and I worked together, we were embarking on a big remediation program to preserve our ability to clear US dollars. Our sworn enemy number one nemesis was a guy called Berners-Lee.
What was the enemy number one?
Berners-Lee, right? Which is was finding specifically foreign banks at the time. And I met Ben again on the board of a company with that, and it turns out it's just a guy. He's actually trying to do the right thing, thinking he's trying to do the right thing. And as a regulator, what I'm trying to make is trying to ultimately doing his best to understand the context in which he's playing and acting accordingly. Most regulators I speak with these days are in a similar position. Understand this is going really fast. I know how to deal with the previous crisis, the current crisis. I'm not sure what is the next thing I'm going to have to deal with. And by the way, I'm understaffed. And we approach most regulators with being under-resourced or not having the bench of expertise in, say, digital assets or cryptocurrencies. Well, guess what? I'm a bank and I'm understaffed too. It's really hard to build a bench of people who are experts in across legal, accounting, tax, everything. From cryptocurrencies to stable coins to the infrastructure that it takes to manage all these things. We're building skills, generally speaking, in banks specifically, in society at large. And so I expect regulators to be up to speed. So there is an element of dialogue and there is an element of education. Sounds terribly hard when you say this, but there's an element of information flow that needs to take place so people are in a better position to deal with the problems that they're going to have to deal with in the future. And that is where most regulators stand at the moment, I think.
The understanding is particularly relevant to crypto because crypto obviously goes across the board. Part of the regulation of crypto has to come to the aspect of it as a security. And the Security Exchange Commission in America is deliberately woefully underfunded. And that's part of the problem. The SEC annually brings in far more in fines than it is given in appropriations. And that's a major reason I think the head of the SEC would like to do more on crypto, but he is severely understaffed.
So we're getting back close to a bunch of bankers advocating that regulators get paid more.
Yes.
Including Ben
Something
Losky,
out
who's
there.
Ben Losky now works for, or used to work for Ripple at one stage. He was-
Well, that's where.
Okay, but there are plenty of questions coming from the audience who are watching this live. So that's why I'm looking at my phone. But let's do the questions here first. Yeah, please. Yeah.
Yeah, so thanks. This is a very insightful discussion, very interesting. I just want to put another additional lens is that there are 88 central banks across the world who are building their own central bank digital currency, right? And I sit on the advisory board of Visa, and they were sharing with
You
us that
stand up, so I'm having trouble. I don't hear that well. You stand up. and-
Yeah, so I'm saying that an additional lens which I want to speak about is that 88 central banks across the world are building their own digital currency, CBDC. And I sit on the advisory board of Visa, and Visa works with all of them. It was shocking to understand that none of them are talking to each other. There is China, there is India, there is LATAM, there is Africa. Each have a very different use case. And my question was that the whole concept of a central bank digital currency means that are you disintermediating the bank? Nobody could have the answer. So my thought is that, and there is no interoperability. So China is making the digital yuan and India is making something. They're all trying to solve different use cases. So what I wonder is that how does that really shape up in the future? And does it create even more chaos?
Let me take a shot at that. I think there has been more coordination among central banks in terms of basic financial, macro-prudential regulation since 2008. I think the crash required them to get together. And what I would predict, say, with regard to the crypto and others, I think they're going to be, there's no mechanism for making it happen. And part of the problem has been it's been low on the agenda for some of the individual banks, at least the need for coordination. I think the turmoil that's now being generated in that area is going to have some influence on getting them to talk to each other. I mean, there's no way to compel it, but I look at the analogy of post-2008, there was a great increase in coordination in terms of the bank regulation in general, macro-prudential, as I said. The only possible silver lining I see in the crowd that we got with crypto is that might generate a similar movement.
I have questions why. Why you did this. Okay, so they
Yeah.
talk to each other, granted. They might talk to each other about how they regulate things, interesting, how they might do it technologically speaking, mildly interesting, I'd say. But the bigger question is actually why.
Yeah.
What is the use case? And it's very different around the world.
I want my panelists to be, highly vocal because we're learning a lot from them. But in writing this book, I travel and visit central bank governors around the world. And I'll say this with my own personal authority on this topic, that CBDCs are designed to fail. Why? Because I sit down with central bank governors who've already implemented CBDCs, specific countries in my head, and the governor telling me that the take-up is almost non-existent. Why? And there's a huge list of reasons. The first being the banks push back on any innovation in payments. The banking industry's original position on payments is make it as inefficient as possible so that we make money on the flow, right? And second, in fact, I didn't have the slide on my presentation just now. The whole idea of crypto wallets is that it reduces the number of intermediaries so much that it makes the wallet players incredibly profitable today in Africa, payment companies are generating real profit just by transacting money in a way that wasn't possible before, just because they don't have to pay Visa and MasterCard and a half a dozen banks and exchange rate as well.
You mean M-Pesa?
Not just M-Pesa, there are many number of payment platforms. Now, what is payments? At the end of the day, payments is information. And if you and I can send WhatsApp information for free, there's absolutely no reason why you can't do payments for free. But in Bahamas, for example, the entire economy is based on Americans swiping their credit cards. So when they introduce CBDCs, there is absolutely no take-up because the entire system is credit card driven. And the banks are profitable, the merchants can get paid by American visitors. So the whole CBDC platform is ancillary to the real platform, which is traditional payment systems. In China, where I spent a lot of time, all the CBDC projects are pilots, and they need to be incentivized for people to even want to use them. There is only one country where CBDC is taken some life, and that's Nigeria. And that's because the central bank is purposely not printing enough cash to pay pensions. And so there's no alternative in that way. There are a number of reasons that CBDCs are designed to fail. Firstly, the banks just would not support. The banking industry in every country, including the UK and Singapore, try to delay even simple things like instant payment as long as they can. Singapore, the delay was 2 years. People forget that. The banks didn't want faster pay to take off in Singapore. Same thing in the UK. It was only when the regulator pushes the agenda and forces the banks to provide this as an infrastructure. And if they push back on instant pay, imagine the pushback on CBDCs, right? Now, and then the BIS, which is where all the central banks meet with each other, the 88 banks that talk to each other. It's interesting how central bankers just love each other. And I know them individually, and I know that, and I have lunch and tea with different central bankers individually, and how the American central bankers talk about conversations with their Chinese counterparts as if they're friends. So we think there's a big trade war going on between the US and China, but the central bankers like and trust each other, and they exchange notes on CBDCs. And they pick on trends one after the other. The whole idea of inflation targeting was a concept that was started in New Zealand, shared at the BIS, and all the central bankers loved the idea. And even Jeremy Powell today says that his job is to keep inflation within a 2% target. How did that idea become global and become prevalent among all central bankers? There's a culture that goes on between all of them. Now, the question that was asked just now in passing on stable coins is the same question that you asked, you asked this question, Barney, which is, so what are the banks going to do, right? So if you have the success of central bank digital currencies, you disintermediate the entire banking industry. What is the banks going to do? What are the banks going to do? And the answer to the central bankers say is that, oh, we'll make them be part of the system anyway. In other words, you're creating a fictitious flow to keep the banks relevant in CBDCs. And on top of that, many countries don't have the governance structure to create the authenticity and the integrity of the CBDC system. Central banks can add interest rates, can create charges, withhold payments, all kinds of issues that gives them more power than what they are entitled to and what they're capable of in the first place. So there is a whole string of reasons. The interesting thing about stable coins is that in US existing infrastructure or legislation, there already exists a mechanism where the OCC can treat a stable coin as a deposit taking company. And in fact, the OCC is talking about it right now. And the other thing that's interesting about the US regulatory infrastructure or the structure in which it holds together is that as far as possible, they keep going back to existing legislation. All the securities fraud, convictions were based on a 1930s law, which is wire fraud. Today, it still works. They don't need to look for new legislations to get criminal convictions going, right? There was
one very important question I have to ask you. You would go to Yellow Bank. Your future. Who does the lending? If I want to buy a house, who do I go to? And if I have a business and I need to borrow money to expand the factory, who do I go to borrow the money?
Barney, even today,
No, tell me.
no, even today, banks are not the largest lenders. They're not the largest mortgage holders anymore. There are commercial companies and private lenders who are not as large, if not larger, than the banks in many countries.
For residential mortgages, but what about the businesses, the small business, who's going to be, and where do they get the money to lend? If there's not deposits, where do they get the money to lend?
That's the question that the new technology players need to answer, because the ones
I'm
that
not
haven't.
talking to the new technology, I'm talking to you.
Yeah. So it's a very important question, and it is being answered right now. Some of them are getting money from their venture funds, which is not valid, because that's borrowed money. It's going to run out, and that's not a way in which to run a business. Some of them are getting money expensively by providing higher interest rate than the next guy, which is also not sustainable. Okay, so that whole dimension of where you get your money cheaply in order to be able to build a lending business, that's work in progress.
No, I think I can't let you off the hook on that. You're the one who wants to abolish the existing frameworks, and I think you have.
The point is that there are many players today who are working at it. So the whole idea of a pay-to-pay infrastructure is that the pay-to-pay players don't even get the loan onto their books. All they do is match individual lenders with individual borrowers. And the pay-to-pay industry evolved for a while, and then it started to stutter because the pay-to-pay players in many of the developed countries, they were always acquiring subprime borrowers to the bank, to the existing banking system. So they're chipping away at the existing infrastructure. The alternative models already exist. You're right, you need to match the borrower with the lender.
Once again, you're asking too much of too many people. Yes, some people will be able to do P2P, but to get enough people, for a lot of people, they don't want to have to, they want to lend their money, but they don't want to be the one who wants to vet the individual borrower. They need to have an institution into which they can put that money.
Yeah,
So lend it in turn, which sounds like a bank to me.
yes. And so the P2P players have to build infrastructure for validating the borrowers and lenders, for creating the credit profile of
They
the.
have to reinvent the bank.
And exactly. So guess what has happened so far?
Why not work with the existing one?
So guess what's happened? The major P2P players prosper and are becoming banks. Okay. So that's what I said in my speech.
Let me
Shirish.
ask. Firstly, I think what your book's really going to do is start this kind of dialogue we're having right here. Now, I know your book starts off by looking at the history of ICE, but finance was personalized many years ago in the form of barter trading. When we all that was what it was. You needed to get something else, and you had whatever you had. You would trade that. And that eventually became, as you know, gold became the value of transfer, which went into banks in the United States, and they issued notes against it, which eventually became fiat currency as we know it today. And then you had the Federal Reserve, and then you had central banks, which evolved because money and value of money is a fundamental issue. There is trust. Okay. I trust a dollar or a Singapore dollar or a US dollar or an Indian rupee because I know it's backed by something. It's got nothing to do with banks per se. Let's forget about the word banks. Let's talk about financial intermediaries. I think the point that Congressman Frank is making on, if I want to borrow, whom do I go to? I think that's a very fundamental and a very important question, and takes you away from this whole concept of personalization of finance, because it has been tried in different places, and we eventually come back to exactly the same point, which is, who is the financial intermediary? Whether it's a bank or you don't call it a bank, you call it whatever you want. Take, for example, your own on point just now, Emmanuel, on P2P, peer-to-peer. Famous example in the United States, Lending Tree, right? You remember Lending Tree, which did extremely well up to a point in time. The business model eventually fails for one simple reason: you run out of customers. When people start saying, yeah, I will lend X amount to so and so, and I'm pooling of assets, and it was credit card assets in that case. They eventually ran out of pooling of assets. They'd gone public. They needed to have more and more assets on their balance sheet that they could intermediate. And they didn't have any more. They started going down the line into SMEs, and they realized that they couldn't provide the credit guarantees, the credit assurances. And eventually the business ran into very serious problems. It's probably running back again, but in a much smaller form than it ever did, right? The fundamental question to personalization of finance comes back exactly to the point that Congressman Frank is making. It's a question of trust. How can I go around banding my own credit to somebody else who doesn't know me at all? Zip. I can't create my own currency. I can't create my own credit. I need somebody else, an intermediary, who starts saying, yes, I agree that this fellow is worth giving $100 to, or $1,000 or $1 million to buy property. And so that's why you're always going to find some institution, financial institution, which is going to be the intermediary. And then the moment you do that, you're going to have to find that there will be regulators who will turn up and say, oh, because eventually this person, this intermediary, is taking money from the public in whatever form you call it, whether you call it dollars or you call it crypto or you call it something else. The moment you go to the public and say, give me something of value so that I can give it to somebody else, regulators are definitely going to get involved in that process. And when you talk about digital payment platforms, okay, there is no successful digital payment platform anywhere. And you take Revolut, for example. For a while, Revolut has even today a market valuation of some $20–30 billion. But actually, you go and find out, what does Revolut actually do? They collect a lot of money. Do they lend any of the money? Whom do they lend the money to? The moment you get into the lending business, it's not as easy. I know a number of players in India who started the same process. Or we can lend money because we come from Goldman Sachs and we have somebody who worked for this digital, we can put this platform. Creating the platform is the easiest thing to do. You just need some people in technology who can create this thing for you, okay? The logistics behind the platform, that is the important thing. How do you lend? Whom do you lend to? And more importantly, how do you collect the money? Okay, you can lend the money, but how do you collect it when somebody fails to pay you? That's the important function that banks play. We gloss over the whole concept of banking. Banking is not just taking deposits. Actually, banking is making loans. And the point about Jamie Dimon saying there's excess deposits, in certain circumstances, when interest rates are negative, okay, and when every time you take a deposit and you have to create an asset, and then the Fed turns around to you and says, oh, you must have a leverage ratio which doesn't exceed X, and suddenly there's a cost of the deposits, that's when you have excess deposits. When there's a positive interest rate and you're getting deposits at zero, there is no such thing as an excess deposit. So the issue.
What I've dealt with in the book, when you take, I'm a big critique of buy now, pay later, because despite all the technology that's being applied to it, the payment itself is no different than what credit cards were already doing, which is basically giving you the opportunity to make your payments installment over time. And the critical success factor in buy now, pay later is not the technology, it's the balance sheet. Firstly, do you have a cheap source of funding in the first place? Secondly, who are your customers? If they're high risk, you have to have enough funding in order to be able to fund the business. And then, are you a subprime player in your marketplace? Because if all the best credit customers in your marketplace are taken by your traditional banks, you're left with nothing but the brunt of the customer base, which is what happened
Buy
in
now,
Australia.
pay later only works when you have a zero interest rate environment.
Absolutely.
The moment you
Yeah.
have positive
Positive.
interest rates,
So
it doesn't work.
correct. So I've taken into account everything you're saying, okay, which is firstly, it's a balance sheet business. Funding cost is important. Credit profiling is important. All of these elements need to exist in order for it to come about. Now, each of these elements are being developed separately, one from the other, and that's why I have the center part of my book, which is to go back into banking, traditional banking, and trying to understand the essence of what creates a credit profile, for example, right? So I talk about Grameen Bank, a country where, or even Indonesia, when Citibank was trying to build its credit card business, what did it do? For the first 10 years, it was taking on non-performing loans of 25% in order to build the credit profile of the Indonesian borrower, to lend out to as many people, collect the data, and then build the infrastructure. That infrastructure itself takes time to build, right? Now, the question is whether with technology they can build it more efficiently, with identity, that individual belongs to a close community, that you can create a profile. So that's where the technology comes in. I also look at, informal sources of financing communities, such as community currencies, for example. In the US, there's at least 5 community currencies that I identified, and then there are many in Africa. What are community currencies? They are close community networks that creates its own token to value work in that network, despite the fact that there's an existing fiat currency for the whole economy. In Kenya, in my book, I talk about Safaru Credit, where in a close community, jobless people, who do itinerant work, are given a token which they can go out and exchange for food, for value in that community. Now, when I look at all these existing models, and you take, what happened in Grameen Bank, which is subprime lending to otherwise non-credit worthy customers. You put 6 women together, they create a viable credit community. Now, when the Indian venture capitalists try to replicate the Grameen Bank, microfinance model in India, they made a very small different change, which is instead of lending to stable communities of villages, of village women, 6 of them in one small group, and making them collectively responsible. In India, they ended up lending to itinerant workers, transit workers coming into the city and living on the fringes of the city. And multiple lenders were lending to the same community. And that's why microfinance just collapsed in India as a result. So these are sensitivities, these are nuances that need to exist, that we can actually dig from traditional banking and then apply it into whatever's being built today into the future.
Let me have one political point on this. Buy now, pay later. The question is, how do you collect if people don't pay? You are going to be running into a very harsh political environment. Buy now, pay later. Helping poor people get into debt is increasingly disfavored. Collecting money from them that you think they shouldn't have borrowed in the first place. So that's going to be the hardest. Right, yeah. I mean, it is very much politically disfavored, and I would need a lot of convincing to take on those odds.
So agreed. A bit of color on Kenya. If you're trying to think of a community bank, it's a box, right? It's a metal box. And on the marketplace, once a year, people will put a bit of money in that box. Everybody knows how much money is being put by everybody else. That money gets dispersed into small loans. Everybody knows how much everybody,
borrowing. And so peer pressure is here to enforce repayment. Ultimately, it kind of works because everybody knows what everybody has done. That is trust revisited. Okay, this is your intermediary in the context of a small community in Agra in Kenya. You know, for what it's worth, we're launching a number of businesses in East Africa, including e-commerce platforms, but also agri-tech businesses matching farmers and commercial kitchens. So we've got exposed to that ecosystem. To the point you're asking, would there be shares? Will there be financial intermediaries? Absolutely yes. There will. Whether it's a box in the middle of the village, or whether it's a bank, or whether it's something else, right? There will be financial intermediaries because we need to answer the previous question. Where are you going to go to when you need money to buy a house and finance business? Second point, are financial intermediaries, some of the new ones, that are being designed to compete against banks, are they all sustainable? The answer is obviously no. The obviously is no because of some conduct issues and suitability issues you're alluding to, but also simply the point which I think we ended up taking the comment in the book, which is it's about the capital structure. It doesn't work to finance debt with expensive equity. That's a problem, right? That's not a sustainable boundary. It's sustainable for 5 minutes. When you ramp up a business, then you need to match your assets and liabilities and so forth. And so the BNP fundamentally, if you're financing debt with equity money, is going to be problematic at some point. Back to you. Well, then why don't you work with existing banks? Well, of course, it's what we're going to do. But that assumes that existing banks will evolve, adopt the technology it takes to evolve, change, and ultimately make themselves useful and relevant, which is what a number of banks and bankers are working on. So we've gone full circle to banks and
You know, I just want to say one thing, because we're talking about openness to new ideas and new experiences. And I want to give recognition of Emmanuel in this regard, not directly financial. But I am married to a much younger man, and under his tutelage, Emmanuel has gone whitewater rafting and paddleboarding, opening himself up to a whole new set of experiences.
Of risks that I never think before. Very good. You know, this conversation can go on, and that's why we set up 2 hours, and it will be, I knew that it was going to be rich, and please continue to join us for lunch. You know, and some of you will be seated with Barney, and anyone can just go up to him and ask him questions, and also Alex. And lunch is in a different place. There are some questions coming in from the internet viewers as well. As maybe I can't take all the questions right now, but one question that was asked is there going to be any more? Are there going to be any more SVB banks in fallouts?
Well, as of now, no, but it depends. There will not be any deposit run generated because the FDIC will now guarantee not just transactional accounts, but all accounts. Whether or not there are some others with bad balance sheets, one, I take credit from our bill from 12 years ago. I do not think you have many, if any, cases where they're going to fail because of toxic assets. But the extent to which, I guess it depends, if the Fed raises more and interest rates go up more, there may be some institutions out there that are going to run into that hit to the balance sheet because of interest rates. I don't think so. And even in that case, we know there won't be any more deposit run generated as long as the FDIC keeps that in place.
Alex, a comment on Credit Suisse.
Just one comment. So first, I started my professional career at Credit Suisse, and I know the corporate is just an artificial construct. It's just a bunch of people in contracts that we give them personality, which they don't actually have. But even, we call it like it's a person, it's not. But that's still I'm sad. I know that I can rationalize it, but I'm still sad because my whole matter is dead, and I can't help but being emotionally affected by the fact that it came out. So first, feeling is one of sadness, and to your point earlier
would make absolute sense. For the sake of what I make is, yeah, let's give those bankers some credit. You know, it makes a difference whether you have a good CEO or not. Shows. Yeah.
Ladies and gentlemen, I am so tempted to continue this conversation, but let's have a continuation as we go along. In writing this book, I did not write it to provide answers. I wrote it to provide a sense of direction from which to validate a lot of what's happening in the industry today. I started this presentation by sharing with you that it's not so much all the noise that we are faced with today that we need to focus on, but to have a sense of direction so that we know how to identify developments that are substantive, long-term. We need to put our fingers on it, and we know that in 10 years, our own lives will be transformed. And then cut out all the little developments that may be just a distraction for what we need to deal with today. And my ideas can go in any direction, and the applications of them, when we drill down to any of the decisions that you need to make, there are profound applications to be thought through, and we could have had a conversation on any one of these topics, on deposits, on crypto, on lending, on platforms, and so on. So I hope that you would have enjoyed, you will enjoy the book. Both Barney and I will be outside to sign for those of you who would like a signature. And I would like to thank Barney for having written the foreword to this book. And as I indicated also, that my friendship with both Barney and Alex is precisely because of the incredible and intense intellectual debates that we have and the intellectual rigor that they provide to my thinking. So I'd like to thank the both of them.